Trading doesn't need to be scary.
So when I first started trading, I went through exactly the same sort of issue that a lot of new traders do. And that was that I was absolutely hopeless at trading. Everything I did was the opposite of what I needed to do. And I was absolutely convinced that the whole thing was fixed and that nobody could make any money from trading. However, I learned over a long period of time that necessarily wasn't the case. I had to go through that process to get to where I needed to get to. And I figured out as well that a lot of people were sort of scared of trading, or certain aspects of trading, things that would force their hand and turn them into bad traders. But it took me quite a few years to be able to shake that off and get to the stage where I am now. I was lucky in some extent that I made all of my mistakes on short-term financial markets. So when I started trading on Betfair, I'd sort of got rid of all of my mistakes and could just plow on with what I knew I needed to do. So the big question is, what do you need to do? So one of the biggest problems you face with trading is fear of loss. And that's quite a natural fear to have, because of course you're trading to try and make some money. You don't want to lose it. But what happens is when you think you're about to lose money, it really dramatically forces your hand in such a way that you end up creating the loss itself. You need to get on the other side of that thought process. Trading is about taking risk, not about avoiding it. You need to be in the market, you need to look at it, and you need to sort of say, this is what I'm going to do and this is the potential payoff. But you have to accept sometimes that that's not going to happen, and then you have to take the loss. And you have to get used to that process. When you take your first loss on a particular trade or a particular market, it hurts a bit. But after your 1000th loss, you won't feel the same amount of angst and pain. So you have to get used to that feeling of taking a loss when you've got something wrong. You need to put your hand up and you need to say, okay, I messed that up, let's take the loss. And of course, what's going to happen is over time, you will be able to make money, because when you do a good trade, that trade will more than cover the losses that you've made. But avoiding a loss is one of the biggest problems that people have. You know, you need to look at the way the market behaves, accept that you're going to make profits sometimes, and accept that you're going to make losses. And it's more about the balance between those two that are important. And if you use all of the sort of strategies and tactics that I often talk about, what I'm trying to do is just tip you over the edge there. I'm sort of saying that rather than making a loss or a profit at random, I'm just trying to show you positions that are more likely to end up in a profit. However, you will still make a loss, and taking that loss is more important. You need to look at the losses as part of the system, not something to be avoided at all cost. So one of the other things that you need to be familiar with about the markets is when we're talking about sports markets and not financials, sports markets are contained. They have a time limitation or a score limitation on their end state. I haven't explained that very well at all. But the practical upshot of that is that unlike in financial markets, your loss is always limited. You can only lose 100% of your stake. And you never should be in a situation where that is the case, because when you're trading, you're not betting, you're not taking an outright position. You're sort of saying the market's going to go from here to there, but sometimes it may go down there. But that's the position that I'm trading in and out. So you should only ever risk a small amount of the capital that you have on that individual trade. But also, and I have highlighted this in other videos and given you practical demonstrations on why this is the case, if you trade at random, but you have some structure behind your trading and you have good money management, your long-term results, even if you have absolutely no skill level whatsoever, will be break even minus a bit of commission. So when you look at the way that markets trade and you look at the structure of sports markets, you quickly realize, or you should quickly realize, that your goal isn't to be the most genius predictor in history, in human history, or to somehow know more than the market. Your primary goal really is to be just a little bit better than random. You need to make better decisions. Join markets at roughly the right time, join the right markets, put roughly the right strategy in, manage your money particularly well, do a good bit of trading, and that's all that you need to do to tip yourself over that edge. And also, you know, when we're looking at a liquid market and stuff where a market is moving around, you only need to be anticipating just slightly ahead of where all of the current price activity is. You don't need to be some genius that's going to accurately forecast something. You just need to be slightly ahead of the curve. When you start, you'll be behind it, and then sooner or later you'll be able to understand why things happened and what influenced that particular price movement and that particular trade. And then eventually, with a bit of practice, you'll nudge yourself over the line where you start seeing it before it happens. And unfortunately, there's no easy way to get there. You're going to have to practice in order to do that. But yeah, the maximum loss that you've got with sports trading tends to be capped. The barrier to profitability is quite small, and your objective as a trader is just to overcome that ever so slightly, be slightly ahead of the market or do slightly better than random. That's your key objective when you're actively trading. So if we look at pre-off horse racing, and I do use this a lot, but it's because it's very simple to understand. It's a pure trading market. There are no particular biases within it, and there are generally in other sports, especially in play. Then you can begin to learn and understand, and be less fearful of the way that the market behaves, because some markets will trend, others will be completely range bound. And I have done videos on which one of those markets is likely to do one of those behaviors or not. But when you get in a range bound market, there's a really interesting thing that occurs, because if you speak to a mathematician, they will look at the market and they will say, well, it's completely random if you went up or down, and therefore you can't make money trading. And that is absolute complete garbage, because yes, the price starts here, and yep, it's on average, it probably ends up more or less where it starts, and the chance of it being up or down is 50%. But when you're trading, you're not interested in that. You don't have to make a decision on every single tick in every single direction. You're sort of going into the market and you're saying, this is where I'm going to enter the market. This is, when I have to exit, because of course we have to exit at post time if we're doing pre-off horse racing. And what's going to happen to the market in between those two periods. And in a range bound market, the price will go up and down and meander all over the place, and it may actually end up exactly where you started. But from a trading perspective, you want to be on the other side of that. Most people end up in the wrong direction. So they open a position here, the price goes down, and they're sort of thinking, oh no, I need it to go up, I'm going to exit, at which point it starts to come back in the other direction, and vice versa. But what you need to be when you're trading is on the other side of that. In a range-bound market, you're sort of effectively selling volatility. When the price moves in one direction, you want to be at the bottom of the market. And when the price is at the top, you want to be at the top, and you want to work inside that range. So to try and simplify what I'm saying here, imagine you've got a coin. You know it's going to be 50-50. Wherever the coin starts, whether it's on heads or tails, it's going to finish on heads or tails 50% of the time. But you're not interested in that. What you're interested in is when you toss that coin, how many times does it end up on heads? So if we sort of sell heads, and then as it spins through the air, we see a heads, then that's one trade done. And then obviously it will spin again, and that's another trade done. So over the course of that particular time period that you're in the market, you have the opportunity to sort of buy or sell heads repeatedly as the coin flies through the air. And really where it ends up is a bit of a insignificance for you. You don't have to worry about that too much, because you're making profit as it meanders through the market. And if you choose the right market, you will get a nice range-bound market where you can participate within that particular traded range, offering money to the market and waiting for other people to take it. So let's have a quick look at a market that behaves exactly like this. So if we have a look at how this market is going to behave, what I'm going to do is put some markers on the screen for you here. This marker, the first marker, will basically indicate to you where the price started. And then I'll subsequently put on markers that will indicate the high point within the market and the low point. But when we look at the way that this market behaves, you can see from our starting point, basically the price meanders around all over the place. But what we'll actually find by the end of this particular market is that it actually ends up exactly where it started. And this was one of the key points that I wanted to make, is there's a definable range here. You work within that range, and what we're doing on this particular video is we're working in this range by putting effectively a one tick offset order into the market. And you'll notice that what I'm doing is I'm only using one order at any one particular moment in time, and that is so that I can contain my risk and also keep my money management on my side. And that is so that we put one trade in, we wait for that trade to fill, and then if it does, we can put another trade in. But if it doesn't fill, that's it. We don't do anything more. And that's how we contain the losses within this particular trade. Now, each market is going to behave slightly differently. And I did pick this particular market, a competitive handicap, to demonstrate this concept because I knew roughly the way that the market would behave. But if, for example, and we're looking at horse racing here, I looked at a maiden where none of the horses had any level of form, that market, if this is the first time they've ever seen a race course, there is no form lines on which people to make a judgment. So the market becomes one that's driven by opinion and emotion. And as a consequence, that becomes a little bit harder to accurately frame. And you tend to find that those markets, if they're uncompetitive markets, tend to, in other words, it's got a shorter price favourite, tend to move around a little bit more. And, this sort of trade probably wouldn't work so well because the traded range is going to be much, much higher. But in a market like this, you can see the way that it meanders up and down. And if we went through that typical beginner trader process of basically saying, the position's gone against me, let's cut out, we would have been intensely frustrated because the price would have done that several times and we probably would have ended up with a loss. But because we understand the way that this market is likely to behave, and because we're working within that particular frame and we're keeping a lid on how we're actively managing the money within the market, we actually end up with a positive trade here. And curiously, on this particular occasion, the price actually ended up exactly where it started. But in the course of that time, it moved around all over the place. And because we were trading effectively, we were able to take advantage of that. Compare that to somebody who's just starting out, they will probably end up on the other side of that because every time the position goes against them, they'll feel the need to panic and get out. Whereas because we understand the market and we've seen this market quite a few times before, we can just sit there and take advantage of it. So trading doesn't have to be scary because ultimately, if you know the way that the market works and you work within that market, you have the ability to be able to exploit other people's behavior effectively. That's what you're doing. And the market will move up and down. People will change their mind and do different things. And you just want to be on the other side of that. When you realize that, it makes your objective when you're trading just that much easier to understand. But also, if you trade at random and you have a structured approach to trading, the maximum loss that you can make is break even minus commission. So there's a natural flaw to the losses that you could possibly make. And your objective as a trader, your mission, should you choose to accept it, is to overcome that barrier and pop yourself on the other side. And you can do that through better market selection, good money management, decent trade selection, and good discipline when you're actively trading. And, the conclusion that I came to over many years is that people sort of tend to get bullied by the market. They're scared of the market or what the market is doing. But as long as you approach the market in a methodical manner and you look at the market and put yourself on the right side of that, there's absolutely no reason why you need to be scared of trading. Trading can be even less scary using BetAngel because you have practice mode. Practice mode can be used with all of the features of BetAngel at exactly the same time, meaning there's no risk to any of your money.